The investment landscape in 2026 is showing cracks in a strategy that many thought was foolproof: diversification. For decades, spreading your investments across stocks, bonds, and other assets was considered the safest path to long-term wealth. But today, that conventional wisdom is being challenged in a way that few expected. Global markets are becoming more interconnected, and traditional asset classes are moving in ways that undermine the protective benefits of diversification. One of the key reasons diversification is failing is correlation. Assets that used to behave differently are now moving together more often than not. When stocks and bonds fall at the same time, your portfolio loses the safety net that diversification was supposed to provide. Even historically stable investments like government bonds are no longer a guaranteed hedge against market turbulence. Another factor is the rise of systemic risks. Geopolitical tensions, technological disruption, and climate-related events are affecting multiple markets simultaneously. These events are not isolated, meaning that even a well-diversified portfolio can experience significant losses during a crisis. Investors are realizing that spreading money across different sectors may not be enough to protect their wealth. The fixed income market, once a reliable anchor for portfolios, is showing signs of strain. Rising interest rates in 2026 have pushed bond prices down, eroding the value of investments that were traditionally considered low risk. For many investors, this shift has been a wake-up call. Relying on historical patterns no longer guarantees safety. Equities are also presenting challenges. While diversification across industries has helped investors navigate past downturns, the current market environment shows that even different sectors can experience simultaneous stress. Technology, finance, and energy markets are increasingly linked through global supply chains, regulatory changes, and investor sentiment, making sector-based diversification less effective. So if traditional diversification is failing, what works instead? Many forward-thinking investors are looking beyond conventional asset classes. Alternative investments such as private equity, real assets, and even emerging digital assets are gaining attention. These investments often behave differently from public markets and can provide a layer of protection when traditional assets are under pressure. Another strategy gaining traction is dynamic allocation. Instead of sticking to a fixed portfolio mix, investors are adjusting their positions based on market conditions, economic signals, and geopolitical risks. This active approach allows for more flexibility and can help mitigate losses during volatile periods. Risk management is also evolving. Sophisticated investors are using tools like options, derivatives, and hedging strategies to protect against downside risks. While these methods require more knowledge and oversight, they can be far more effective in a world where traditional diversification is no longer sufficient. Geographic diversification is another key. Investing across multiple countries and regions can still provide benefits, especially when global economic cycles are out of sync. However, investors must be careful to account for currency risks, political instability, and other factors that can affect international returns. Behavioral factors are equally important. In times of market stress, investors often make emotional decisions that can hurt performance. Modern strategies emphasize disciplined approaches, using systematic rules to adjust portfolios rather than relying on intuition alone. Data-driven investing is becoming essential. Advanced analytics, artificial intelligence, and real-time market monitoring allow investors to identify correlations, detect early signs of risk, and adjust their portfolios proactively. This level of insight was simply unavailable to most investors a decade ago. Investors are also exploring niche sectors that are less correlated with the broader market. This can include specialized commodities, emerging technologies, or sectors poised to benefit from long-term trends like renewable energy and healthcare innovation. Identifying these opportunities requires research, but they can provide meaningful diversification when traditional assets are moving in unison. Ultimately, the failure of traditional diversification is a wake-up call. Investors can no longer assume that spreading money across conventional stocks and bonds is enough to protect their wealth. Instead, a combination of alternative assets, dynamic allocation, risk management tools, and data-driven strategies is required to navigate the complexity of 2026's financial markets. For those willing to adapt, the opportunities are still significant, and success now depends on being proactive, informed, and flexible.